Hey everybody, welcome to Multi-Million Dollar Mortgages with myself, Robert Klein, mortgage broker. So let's get right into this. Who is this presentation really designed for? And I think there's really three groups of people. First one is going to be real estate investors. Second is going to be people that own their own companies or they have operating companies. And third are people that are high net worth. I would actually say a few years ago, you didn't really need that much planning or structuring for high net worth. There's a bunch of equity type programs out there where you just walk in and they give you the mortgage and that was the end of it. But today that type of programs have been wiped out. So they now actually have to structure and plan accordingly too. So what will you learn? What it takes to structure millions or tens of millions of dollars of mortgage financing for the Canadian real estate market. And I would say there's really three levels of financing that people would really consider. Level one is the beginner stuff where you go out, you find a property that you like, you get approved from the lender, then you purchase the property. And if everything goes well, great. But if it doesn't go well, then level two financing kicks in where everyone suggests, hey, instead of going out and trying to find properties, let's go first to a bank, get pre-approved from the lender first, then go purchase the property. And level one and level two work quite well for basic stuff. Now, if you want to go to millions and millions of dollars worth of financing, level one and level two will not work. Now we got to go level three financing. And what's level three financing? It's this. Find out what the banks will lend on in general, regardless of your situation. Then position your financials around what the banks will easily lend on. And that right there is pretty much how you structure into millions and millions of dollars worth of mortgages. So here's you, here's the mortgage broker, here's the lenders. So obviously the job of a mortgage broker is to represent you to the lenders so you can get that mortgage. So let's say, for example, if you're a first-time home buyer and you wanted a $300,000 mortgage, who's the most important person in this equation? Well, in reality, it's you. Because any mortgage broker, any lender, anything, as long as you make your 60 or 70, 60 grand a year, you're pretty much approved without much work. But let's say, for example, you wanted to go from $1 million in mortgages to $10 million in mortgages. Who's going to be the most important person for that equation? Well, in my sort of biased opinion, I'm going to say the mortgage broker is by far the most important person to get you into that type of level of financing. And the reason I say that is one of the main jobs of a mortgage broker at this level is to structure your finances the exact way the bank wants to see them in order for you to qualify for a mortgage for that specific property. So when you own millions and millions of dollars of the real estate and you have operating companies and you're all over the place, there are so many different ways of doing everything that if you do it incorrectly, the lending can shut down. So you got to do it correctly and planned accordingly. So we've heard the term financial planning. I'm going to call this mortgage planning. So let's go through 5 quick examples of deals that I've done. Let's go example number 1. 4 fourplexes in Surrey. The client made $56,000 worth of income, and we were able to qualify him for $3 million worth of mortgages. So that's example number 1. I'm going to go through this quickly. I will actually go into a bit more detail on these cases down the road. Example number 2, a $4.5 million condo in Vancouver, purchased as a rental, approved at 0% down. Now, if I was going to be honest with you, it wasn't 0% down. It was negative 30% down, meaning that they were going to finance, they approved a 0% down loan, plus they're going to give a $1.5 million unsecured line of credit. So they're literally giving them $6 million on that property. Now, if you're wondering quickly how that was possible, the short answer is commercial financing. Example number 3, $1.95 million mortgage, 8 short-term rental Whistler condos. So if you don't know anything about short-term rentals, lenders do not like it. And if you know anything about Whistler, where there's actually like phase 2 properties, which are designed for like hotel type things where you're not even allowed to live in them, they don't like that even more. So to even get a basic financing for a single lender to give you one mortgage on exception because maybe you have a long-term relationship with that lender, that's where it happens. But to own 8 of them or to own a lot of them and to finance a whole portfolio of it, that was quite difficult. But short answer, that was done. Example number 4, $1.95 million mortgage, 27-unit building out in Ontario. CIBC was offering 4.05% on a 10-year term for renewal. By bypassing the banks and going direct to the pension funds, instead of doing 4.05, we got 3.2 on the 10-year term. Example number 5, $4.4 million purchase. The maximum mortgage the property would actually allow to have, like that actually supports itself, is 1.57 million. That means any investor that was to go buy this building as an investment on its own merits, the max loan you're going to get is 1.5. That means you need to put like $3 million down. Well, this client used their operating company, and we were able to go from 1.5 to 3.75 million, or 15% down. Just a side note, this is not the building that they bought. This is just a building I found online. I'm not going to put the actual building that they did buy, but it was a property out in Vancouver. So there's 5 quick examples. So who is Robert Klein as a mortgage broker? And I think this is going to be a very important question, especially if you're getting into the world of millions and millions of dollars worth of mortgages. So I'm going to say there's about 5 skill sets required to be successful at this level. First is you got to be mathematical, meaning that you know the math of mortgages inside and out. You build out your own Excel sheets. You're not dependent on other people's software to figure out the math. You know this stuff beautifully. Second is you got to be creative, meaning that you'll take a single problem and just keep on trying to solve it 50 different ways. Relentless means that you'll sit on a problem longer than anybody else will. I actually just had a client that is taking me 8 months to finally get them an approval. But I kept on going at it, and then eventually got solved. Strategical. So strategical, there's a lot of different components to being strategical. But if you're, for example, buying property number 4, we should be asking ourselves, well, how does property number 4 affect properties 1, 2, and 3? Or how does property 4 affect our future purchases of properties 5, 6, 7, 8, and 9? Then there's, how do we buy it corporately? Do we buy it in our personal name? Who's on title? There's a lot of things which you'll see to make this work on the strategy side. Networked. When I say networked, I'm more thinking on the lines, not so much in terms of business, but network inside of the banks and getting access to the smartest people in the banks to get things done. So let's go through the history of me. 2002, back when I was in university, I ended up taking a course. Well, one of the courses I took was literally a 400-page book on mortgage math being applied to industrial stuff. So because it was math, I actually ended up skipping all the classes because I knew I could pretty much learn the whole course the night before. And back then, I was one of the few people that knew how to use a TI-92 plus calculator when I was at UBC, which basically allowed me to program everything. So I actually programmed all the equations. And so when I walked into the midterm and to the finals, all I did was I wrote the equations that I wrote into TI-92 plus, or what I wrote into the calculator. And then I put the variables, and then I pressed enter. And then instead of doing a page and a half worth of proof or work, the answer came out immediately. And what took an hour for a midterm, I was out in 20 minutes. The first midterm, I got 100%. Second midterm, I got 100%. Then the final exam, I got 80. I'm assuming I got 80 because I was probably learning 6 courses in 5 days for the final exam. So the most funny part of this, though, is that after the teacher saw what I was doing with this calculator, she banned this calculator and pretty much gave the students, she would actually buy the calculators for the students for the exams, and she would then give it to them. So I think that was the more funnier component of it. So out of the skill sets required, even back then, that shows that it's pretty mathematical and creative when it came to mortgages. Let's fast forward 2008. I ended up buying, owning, flipping 17 properties in Winnipeg. I started, and I wasn't a mortgage broker at the time. I started with 20% down. Then I figured out how to get 10% down. Then I figured out how to do 5% down. Then I figured out how to do 2% down. Then I figured out how to get 2% down plus 10% renovations. Then I'd get 2% down plus 30% renovations. As I was working with multiple brokers to figure this out, a lot of them didn't even really believe that this was possible to do, but I kept on pursuing it. And even though I wasn't a broker at the time, I was able to figure it out. So what that meant was I'd buy a $100,000 property for $2,000, and then they would give me a check for $30,000 to renovate it. So there's that. So that was sort of me being relentless in terms of going down that rabbit hole of how do I put the most minimal amount of money down. And I would say today that the only program that still exists out of that is just the 20% down. Everything else that you saw there is now gone. So 2009, I take my mortgage broker license. Takes me 2 weeks worth of studying straight. Generally takes people, 2 or 3 months. 1 hour exam. It's a 3-hour exam. Did it in an hour. 91% was the mark. Now, why on earth would I ever show this to you? Again, it's just to say that in terms of a mathematical point of view, I'm pretty good at the math of mortgages, which is important to you if you're going to structure millions and millions of dollars worth of mortgages. So in 2009, I get my license. Instead of working with the first-time home buyers, I immediately start dealing with real estate investors. So people who own four houses, 8 houses, 10 houses, I dealt with them. And back then, you really just needed to be mathematical and creative, and you can do quite well in that market. Fast forward to today, someone walks in with 10 houses owned in their personal name. To deal with that, you need to be mathematical, creative, relentless, strategical, network. You need to be everything because the banking system is now against that kind of stuff. So fast forward 2012, 2013, 2014, because I'm always dealing with real estate investors, I get to deal with lots more different problems. So 2 of the questions I got really good at answering was, how should I structure ownership of property? And how should I structure my income to qualify for property? So in terms of the ownership point of view, there you can own it in your personal name. You can have real estate holding companies, operating companies, family trust, in trust. Now, in terms of how I should structure my income, pay yourself dividends, pay yourself a normal income or salary, keep it in the company, transfer to other companies, and which family members should get paid. So generally speaking, all of this is usually addressed in terms of a tax point of view. And it's never addressed in terms of a mortgage point of view. And that was okay until very recently, where you have to really structure things in terms of a mortgage point of view, then you optimize in terms of the tax point of view. And that's really the way that you have to do it to get access to the financing. So this is sort of, in terms of a skill set point of view, was creative and being very, very strategical. 2016 comes around. I end up having a client who had a $3 million principal residence, who owned a $3 million rental, and wanted to buy another $3 million rental. And he had an operating company with a net income inside of the company. Husband was paid salary. The wife was paid dividends. The adult child was paid dividends. There was about $300K net income inside of the company, and about $5.1 million worth of mortgages was required. So just to give you a heads up, that is it was extraordinarily difficult, to the point that I had to rethink mortgage math on its own merits. And if you're in the industry and you're watching this, GDS TDS is a very inefficient way of analyzing mortgages. So I actually had to reverse the math, and I sat down at a Starbucks. It took me about 2 hours to sort of model out the different way of looking at mortgages, and I was able to figure it out. And then from that point on, I ended up just analyzing the properties in terms of how I would look at it. Then later in 2017 or 2018, I did a post on Facebook where there's about 4,000 mortgage brokers on it, for Canadian mortgage brokers. And I actually showed them how I actually built out a much smarter way of analyzing all these properties, or analyzing these mortgages against multiple banks. And I ended up getting 670 people requesting access to what I built. And because of that, I ended up building out some software called Lender Analysis. You can go online, and pretty much a bunch of mortgage brokers use that today to analyze difficult situations. So that sort of shows in terms of a skill set point of view, mathematical, creative, and pretty relentless. In 2016, again, I actually probably took the most important course I've ever taken in my life, which is a course that introduced me to commercial financing. And it taught me two things. It taught me about commercial financing, and then it taught me that I could build relationships direct with people at the banks. 80% of my business today is now based on commercial financing and working direct with people at the banks. This totally changed my entire paradigm on what mortgages or mortgage brokering actually is. So this was me being very strategical and networked, or I became very, this totally changed my perspective where I'm strategical and now I'm networked inside of the banks. Now, what's my future look like? Because of what I've learned over the last 3 years in commercial, I definitely see properties in terms of a commercial point of view, in terms of a financial point of view, a lot more than what I did before. I didn't understand commercial financing. So today, I'm actually now buying development land, developing condos or apartments, and keeping the condos long term. And this is all because I figured out the commercial financing side of things, and I was able to leverage that to build a team to do exactly this. So that's where my future is. Now, if I were to go 20 years ahead, here's one of my perspectives. And this is more personal to my business, but I know my mortgage business is worth nothing or close to it 20 years from now. I know I'm not going to sell it for anything. What it's going to be worth 20 years from now is going to be my real estate. So my real estate will be worth pretty much everything, in my opinion. And if you're a business owner, or even if you're employed, I think you should give that some thought, because even though you may build a successful business, I'm pretty sure that how you invest into real estate will 10x the value of that for sure. So my net worth will be dictated by the real estate that I own and not by the income my business produces. So this is something that I pretty much believe in and I've seen. So these are the skill sets that you pretty much will want in whoever represents you to banks. So let's get into this. How many lenders does a bank have? Now, this is sort of a weird question, because you would think if you went into a major bank in Canada, that bank has one lender. Well, it's not true. When you walk into a bank, there's multiple. So there's branch level, there's branch managers, there's mobile specialists on the residential side. There's mortgage broker divisions where mortgage brokers go to. There's small business lending, which is like commercial financing, less than $1.5 million or less than $1 million. Then there's commercial financing with 10 different divisions inside of that. Then there's private banking for high net worth. So if you look at all of these divisions, what you'll get is in every single division, there are different mortgage rules and different guidelines, every single one of them. And inside of each division, you'll find that people there are either average, to say it politely, or geniuses. My job has now been, over the last 3 years, to collect and build relationships and collect those relationships, build relationships with the most smartest people in each division inside of these banks. And if you were to look at 6 banks as an example, literally my goal here is to build an army of the smartest people in the financing world and work with them to get deals done. So if you are one of these people that works at the bank and you know you are excellent at what you do, please email me at robert@robertkleinmortgagegroup.com. I would love to talk to you and learn about what you do, and I would love to send you business and learn everything that you actually what your specialty is. So here's an interesting thing. Top 5 banks in Canada. So this is the average mortgage broker point of view. This was me pre-2016. So I'm a mortgage broker. So now think about this. If every bank in Canada has at least 10 divisions of financing, that means there's 50 divisions of lending with 50 different sets of rules. Before, I was actually only contracted or worked with 2 out of the 50. The other 48 I thought of as my competition, or I didn't even know that existed. So obviously that's just not good. So now I'm working with pretty much everything I possibly can. So that's how many lenders does a bank have? Turns out a lot. Let's get into residential properties. How much personal income do you need for $1 million properties, for if you want to buy $1 million property? So usually what you hear in the media is the most extreme amounts of money. What you don't see is everything else. So if you bought $1 million condo at 5% down, you need about $195,000 worth of income to make that work. If you bought it with 20% down, the qualification rules lower, but more importantly, your down payment is larger. So now your income required is $135,000. But let's say you bought $1 million house at 20% down, and there was a basement suite with $1,500 a month in it. Well, now your income drops to $97,000. How about $1 million house at 20% down, and you rent out the main house and you live in the basement? Now, I only know one lender that does this, but now the income drops to $85,000. How about $1 million triplex at 20% down? You live in one and you rent out the 2 suites for $3,000 a month. You now need $67,000 worth of income. Much different than the $200,000 everyone's talking about. How about $1 million fourplex at 20% down with 3 suites at $4,000 a month? Your income required is $41,000. I actually had a client do that 5 or 6 years ago in Vancouver. They bought $1 million place. It was a fourplex. The guy's income was like 54 grand to qualify for it. And now that property went up 600 grand. So now how about this? $1 million fourplex at 25% down. You're renting out all 4 suites for 5 grand a month, and you live at home with your parents, and you still go to school. And maybe your parents are paying out dividends from a company. You need a $20,000 income to qualify for that $750,000 mortgage. How do I know that? Because I've had a couple clients do exactly like this. They didn't make 20 grand. I can see some issues with 20,000, but they're in the $40,000, $50,000 range, and they qualified. How about this? $1 million multi-unit 12-plex at 15% down. Well, the income required is 0 because it's commercial financing. They don't care about your personal financing. They don't care about your personal income. It's irrelevant on the commercial side. I would say it's like 99% irrelevant. $1 million warehouse at 25% down. Well, your personal income required is 0. How about $1 million 6-unit office space at 25% down? Again, commercial. Your income required 0. How about $1 million retail space at 25% down? Income required 0 because it's commercial. So how much personal income do you need for $1 million properties? Well, it technically ranges from 0 to $195,000. How about this? Scalability of financing for a 700 grand condo versus a $1.2 million fourplex. So how do banks look at this? Let's say you're going to buy a 700 grand condo versus a $1.2 million fourplex. What's the most scalable? So a 700 grand condo, $2,500 a month in rent, $250 a month strata, $130 a month in taxes. Now, $1.2 million fourplex, $6,000 a month in rent, $400 a month in taxes. Okay. So what's the difference? Let's see how a bank looks at this. So we got a 700 grand purchase price. We need to put 25% down. So we got a $525,000 mortgage. Our qualifying rate is 5.3% for 30 years. So even though the rate's going to be lower, like in the low 3s or high 2s or wherever it is at the time, they're going to qualify you at 5.3. Therefore, the mortgage payment is $2,915 a month, plus strata $250 a month, plus taxes $130 a month. We have a total of $32.95 a month we have to cover. But because it's a rental, we get to use rental income. So we got a 1-bedroom condo in Vancouver. $2,500 a month is, believe it or not, reasonable. Especially for a 700 grand condo. Now, the thing is this, a $2,500 a month rental income, we're not allowed to use 100% of it. At the best, we can use 80%. So that means we're allowed $2 grand a month to work with for the calculations. So income minus expense, we have a $2,000 a month income minus the expense of $32.95 a month equals $1,295 a month. That's the deficit. Our personal income has to offset this. So I call it income supplement. So $1,295 a month times that by 12. Then banks only allow you to use 40% of your income, approximately 40% of your income, to basically support a mortgage. So we got to take this deficit and convert it into your personal income. So what I'm going to do is just divide this by 40%. And what this means is that this property is going to eat up $38,850 worth of your personal income. So if you have a 100 grand income This property just ate up 38,000 of it. Now you got 62,000 left to deal with your own principal residence mortgage, your car payments, your other properties, etc. Okay. So now let's go to the $1.2 million example. 75%, so we got 900 grand mortgage, qualifying rate of 5.3% of 30 years. Mortgage is $4,997 a month, plus taxes of $400 a month. Total $5,497 a month. Okay, now rental income, $6,000 a month. We're able to use 80% of it on the high side. Just give you a note. Lots of banks use 50, and even more use 20%. And you'll find that in a couple of the big banks in Canada. So $4,800 a month we're allowed to work with. Income minus expense, $4,800 a month minus $5,497 a month equals negative $697 a month. Times that by 12 to figure out our annual loss. Now we're only allowed to use 40% of our income, so we got to sort of divide that to convert it to an income amount. So this property for $1.2 million costs us $20,900 out of our personal income for their calculations. So here we go, 38 grand supplement for a 700 grand condo, or a $20,000 supplement for 1.2 million. But if you actually make it apples to apples, what that means is that the condo consumes up 3.18 times more income requirements versus what the fourplex does. So buying lots of condos is actually buying lots of Vancouver condos in this example is actually quite difficult. So if you remember that example number one, when I talked about the client who had four fourplexes in Surrey on a 56 grand income. Well, one of the major components of why this deal worked is because of how much rental income was being produced from them. So there's a scalability, a 700 grand condo versus a $1.2 million fourplex. And this type of equation, this type of math should be applied to every property on the residential side that you purchase. How to own 20 residential properties. So I'm going to sort of give you the generics here, but don't do it if you don't have to. But there are a couple easy ways of doing it. Or actually, there's only one easy way of doing it. The only easy way of doing it, well, maybe I got to explain this. The reason that you don't want to do it is because it's the equivalent of dodging bullets in the Matrix, because everything is set up against you to actually make it work. But the reality is there's one way to really do it, and that's really to structure joint ventures. Have them buy the property, their down payment, their credit, and then structure the ownership after the fact. The other alternative is private banking. And private banking a few years ago would have had way more options than what they had today. But if you were a certain net worth, you can walk into private banking, and if you own 10, 15, 20 properties, they would do them all. But that has been quite restrictive now, and you need to, anyways, it's really on a case-by-case basis. But let's say, for example, you wanted to do this in your personal name, and you actually had the down payments to do all of this. I'm just going to list out what it is. I'm not going to explain the details of why it is, but you definitely don't want to be going down this route in general, because you're just creating a total headache for yourself. So here's what I would do. If I had to go buy 20 rental properties or 20 properties in my personal name or in my name, I'd own them all. First of all, I'd own all rental properties in holding companies. That's step one. Step two, get the mortgage based on it being owned in the holding company. So sometimes people will buy a property and then they will transfer ownership or set up a beneficial trust into a corporation. You don't want to be doing that. Do not mix banks per holding company. So if you're working with Bank A and there's 3 mortgages there, make sure all three mortgages are with Bank A. Provide one personal guarantee if possible. So if the bank's asking for another guarantee from your other spouse, try not to give it if you don't have to. In terms of a qualifying point of view, you just might have to. Never give up an operating company's corporate guarantee if you don't have to. So this is another entire topic on its own, but sometimes you might give it, but most likely not. For every $1 million to $2 million worth of mortgages, set up a new holding company. Go to specific banks in a specific order. Start with a weak bank and end with a strong bank based on qualifying. Go to specific divisions in that bank in a specific order. And as you do all this, you're basically spending a ton of time and ton of effort just dodging bullets all over the place when you're doing this. Now, if I were to go about it, I would actually target branch manager, mobile specialist, mortgage brokers first. I'd maximize what's available there. Then I would go to multiple different banks and do the same until they basically tell me we cannot touch you anymore. I would then start hitting up small business lending, commercial financing, private banking, because all three of those technically can put commercial lending on residential properties. But then again, I would totally avoid all of this in general. So what I would not do, and this is what most people did 10 years ago, and they obviously did very financially well, but this is what I would not do today. Own all your properties in your personal name and put both spouses on title and mortgages. That's a formula for really maybe owning 5 properties, and then you're pretty much shut down. So that's how to own 20 residential properties. Step 1, in today's market, don't do it. There's probably smarter ways to own different types of property that are a lot more scalable, which I'm going to go through. Commercial properties. Let's get into it. Commercial property fundamentals. So here it is. Market value equals net operating income divided by cap rate. So net operating income equals income minus expenses. So this is how they value properties, the market rate, net income divided by cap. So what's your income? Well, generally 99% of it is going to be your rental income. You might get laundry income, maybe some interest income from your deposits at the bank. But generally it's going to be all rental income. Your expenses are going to be property tax, insurance, strata, property management, landscaping, waste removal, water, electricity, gas, repairs, legal, etc. But what expenses is not is mortgage interest or mortgage payment. That's more to do with a cash flow calculation. The reason is that mortgages are different from person to person. Someone might buy cash, someone might buy it with 50% down, someone might buy it for 80%. So they're not going to compare that. What they're going to compare is something that's equal, that everyone would be equal on. So income minus expense don't include anything to do with mortgages or financing. So let's say we have a property with 200 grand worth of income coming in, expenses are 80,000, our net operating income is $120,000. Okay, so let's go here. Market value equals net operating income divided by cap rate. So the value of the property. So we got $120,000 income. Cap rate is sort of like the rate of return that you're going to get on something. So to make it, I'm going to go into a bit detail here, try to do my best to explain it, because cap rate, if you're not used to that word, it's sort of weird. Or at least it was weird for me to figure it out. So cap rate, if you bought a $100,000 term deposit that paid you out $3 grand a year, your cap rate would be a 3%. So this rate of return on this would be 3%. If you bought $1 million property cash, so there's no mortgages, and it produced you a net income of $50,000, your cap rate would be 5%. Okay. So let's calculate cap rate. What is the cap rate of a $2 million property with a net income of $120,000? So we reverse the math. Cap rate actually equals net operating income, or like the income it produces divided by what you bought it for, or the purchase price. So $120,000 divided by 2 million equals a 6% cap rate. What is the cap rate of a $3 million property with a net income of $120,000? Cap rate equals net operating income divided by purchase price. 120K divided by 3 million equals, we got a cap rate now of 4%. Okay. So let's go back to this. Market value, we got a property that makes 120 grand a year. And let's say we wanted to buy this property in Edmonton. And in Edmonton, the area was trading at a 6% cap rate. That's how they look at things. It's per area and also per property. But in general, they're going to look at per area. So at 6% in Edmonton, 120 grand net income divided by 6% means that our price or our cost of this building is $2 million. But let's say we wanted to buy the exact same building in Toronto. And in Toronto, they're trading at a 4% cap rate. That means this property, 120 grand divided by 4%, is $3 million. Now, how about we go into Vancouver, where cap rates are actually less than 3%, probably 2.5, 2.7. But let's say 3% for Vancouver. Well, how much does that exact building cost in Vancouver? 120 grand divided by 3%, $4 million. So there's how market value, or how the value of buildings for commercial generally is calculated like a 99% of the time. Obviously, if you have a commercial property and it could be rezoned for a 70-unit condo tower, then that's a radically different calculation for valuation. But for this part, for most commercial, this is how it's going to be calculated. So now that's commercial property fundamentals. How to increase commercial property values. So this is something that residential can't do. You can control this part, or you can do a lot to control this part. So 3 ways to increase the value of a commercial building. So here, market value equals net operating income divided by cap rate. What's net operating income? It's income minus expenses divided by cap rate. Okay, so then if we want to increase the value of the building, if we increase the income of the building, the value increases. If we decrease the expenses, the value increases. If the cap rate lowers, like there's more demand for the area, then the value of the building increases. So this is something that residential does not do. So here's a question. If we increase the income by $10,000 a year and the building trades at a 4% cap, how much did we make? Well, you would think, well, I made $10,000 more a year in income. Like that's it. In the residential world, that would be pretty much true, but not in the commercial world. So here it is, income minus expense, right? So divided by cap rate. Well, our income just went up by 10 grand. So that 10 grand increase at a 4% cap rate, the value of your building just went up $250,000. How about this? If the building had 16 suites, how much per suite would the rent have to increase? Okay. So we want 10 grand more a year divided by 16 suites, $625 a year per suite means that we need to increase the rent per suite by $52 a month. So if we increase each suite's rental income by $52 a month, the value of the property increases by $250,000. And you can't do that in residential. So market value equals net operating income divided by cap rate. Now here's another question. If the demand for an area increases and the cap rate decreases from 5% to 4%, how much did the building value go up? Okay, well here's market value equals net operating income divided by cap rate. So we're at 5% to 4%. So in a nutshell, the easy way of doing it is if the area has more demand, it goes from 5% to 4%, or if actually interest rates lower, and that's another thing to look at, but in a nutshell, 5% to 4%, the value of the building on its own just increased by 25% in value. How about if it goes from 5% to 3%? Now you're at 67% increase in value. And that's actually probably what happened to Vancouver over the last 10 years. The cap rates went from like a 5 down to 3. How about you buy in Ontario or some other smaller towns or Edmonton or something, and you bought at 8% and there's more demand, there's more action going on in that area, and it went from 8% to 6%, well, the increase of that property would be 33% in value. How about 8% to 5%? That's a 60% increase in value. This does not happen in residential. So that's increasing in commercial property values. What do investors look for in commercial? Well, it's really simple. They want to increase the income. They want to decrease expenses. They want a lower cap rate. And this is I would say is the fundamental. There's more to this, but that's going to be the base. So if they can find a building where the rents have not been increased for 10 years and everything's below market and it's all these old leases, they want to find a property like that. How about mismanaged properties where the expenses are too high and they can fix that and make the expenses lower? They want to find that. And then how about areas where more demand will occur, like a government infrastructure being put into place, like bridges, or the population is consistently always growing more and more and more. That will increase or that would decrease the cap rate of those properties. Another thing that you always want to take a look at is actually the government bonds. So if you look 10 years ago, government bonds were 4% plus. Since 2012, it's really gone down from 2% down to less than 1%. And there was a time in 2016 where you could get CMHC insured lending. You could buy like a 40-unit multi-unit building at like 1.7%. So you also want to factor this into play, because if rates start going up dramatically, well, cap rates on its own merits will actually will go up too, which will not be any good. So, and the reason this increased the value of the buildings is that now there was more money was available for qualifying to buy these things, which then decreased the cap rate. So what do investors look for in commercial? Well, there you go. That's pretty much what that's probably one of the core fundamentals of what they're looking for. So here's a case study. $4.4 million Vancouver commercial property purchase. So this, as I mentioned before, this was not the building, but it's 3 stories in Vancouver. It was actually a much nicer looking building than that one. Floor 1, $5,000 a month rent plus triple net. Floor 2 rented out for $3,000 a month plus triple net. Floor 3 rented out for $2,500 a month plus triple net. That means we're working with $10,500 a month with triple net. So you might ask yourself, what is triple net? Triple net means tenants pay for property taxes, insurance, and maintenance. So they're basically covering the large part of the expenses of this property. So what income will we be working with? So I'm just going to assume that we're going to base it on the full $10,500 a month, because I'm going to assume there's no expenses. There probably is some, but I'm just going to make it simple. But will the bank view this $10,500 a month as an income that we can use? And the answer is no. What they want to see is something called a debt coverage ratio. And we can use 1.2 as an example. And what that means is they want to have a buffer. They want to use $10,500 a month divided by 1.2 means we're allowed to use $8,750 a month to support the mortgage. Okay. So what's the maximum mortgage if we're working with $8,750 a month? Well, if we had a 4.5% rate at 25-year amortization, the maximum mortgage this property qualifies for is $1.574 million. That means this down payment for this client is $4.4 million minus 1.57. He only needs $2.8 million down. Sounds like a super good deal. That is 64% down. And guess what? If you're an investor and you're buying that building on its own merit without anything else, that's pretty much what you have to do. That's the best of it. And this is what's happening in Vancouver and most likely in Toronto when people are buying sub 3% cap rate buildings. They're finding out that no, the banks won't finance any of it. So let's actually go back to this equation. The math I used there was like the best banks. Let's talk about some of the biggest banks that you know. $8,750 a month at 6%. So that's the qualifying rate that they're going to do. They're going to put a buffer on there. And instead of doing 25-year amortizations, they're going to do 20 years. So now the mortgage is $1.22 million. They need a down payment, 4.4 minus 1.22, of $3.179 million. So this is why in the commercial world, commercial realtors like cash buyers, because, well, you see why. The mortgage financing for this stuff is pretty much worthless. Now, here's the thing. That means you need 72% down. Okay, so how did I get my client 15% down? Okay, here's how I did it. Operating companies plus owner occupied. The person was actually going to move his business into it, and the operating company was strong. So we reverse engineer the math. Look at a $4.4 million property, 85% loan to value. So now we have $3.74 million worth of mortgages required. At 4.5% at 25-year amortization, we have a $20,788 a month component to support. Don't forget the debt coverage ratio of 1.2. And now we're at $24,945 a month. So here's the whole trick. If the rents of the property and the profits from the corporation are greater than $24,945 a month, this deal is pretty doable. Note, profits from the corporation does not equal net operating income. Every single line in your corporate financials has to be discussed in order to determine that number. And that's obviously one of the things that I do, and I do very well. So who should be considering this? Who should be doing this? Okay, well, any business that pays a lease should consider probably owning it. Anyone who's incorporated and wants to use their corporation to buy property. So it's pretty much an untouched piece of lending that can get you into some amazing property if you know what you're doing and if you have proper planning structure. So there's the case study. That's pretty much how I got 15% down on a $4.4 million property at a 2.6% cap rate property. How about 100% commercial financing? Well, I mentioned that client got 85%. Well, how about 100? Well, there are certain groups of people that banks really, really, really like. And one of them is doctors. They'll give them 100%. Dentists, 100%. Accountants, 100%. Engineers, 100%. Super successful businesses on exception, case by case, 100%, as long as it makes sense to the bank. So the number one error I see these businesses do is that they only buy a single unit for their own business. In reality, they could have bought the entire building. Now, obviously, there are restrictions because I have a couple of my clients who could only buy that single unit. So here's another more of extreme example. I know 3 doctors that work together. Were not my client, but they built a $10 million medical building out in the Fraser Valley, 100% financed, 0% down. That's a pretty good deal. And it's pretty much because they're doctors and there's 3 of them that got together, which meant they have 3 corporate financials to work together to make something like that work. There you go. And also, if you're watching this and you're thinking about joint venture partners, so here's a tip. Doctors, dentists, engineers, accountants that run successful businesses they walk on water with the right institutions for getting access to financing. So how about scalable commercial financing? So everything I talked about was sort of like, what's scalable? What is the kind of stuff that banks will throw $10 million, $20 million, $50 million at you as long as you have the down payments? Okay, so let's figure out that. What's truly scalable? So how do you calculate that? What type of properties will banks provide endless maximized financing for? Well, the answer is this: self-supporting commercial properties. That's pretty much where the answer is. So what that means is that the net operating income of the property has to fully support the mortgage payment. So this applies to office, industrial, retail, self-storage, residential. So here's the question: what cap rate should you be buying at or looking for to make this work? So you know cap rates in Vancouver are at 2.7%. So that means you can just walk into Vancouver and go buy an endless amount? No, because the financing does not support it. So let's go through an example. $1 million property, 25% down, 25-year amortization, 4.3% rate, debt coverage 1.2. So what cap rate, based on this, can we buy at? So first thing we're going to do is figure out what the mortgage amount is. So at 25% down, we got $750,000. We got $750,000 mortgage. Mortgage payment $750 at 25 years at 4.3%. Basically, it's $49,000 a year worth of payments. We have a debt coverage ratio of 1.2. That means we have $58,818 as payment that has to be supported by the property itself. What that really means is that our net operating income minimum is $58,818. So if we're buying the property at $1 million and we know we need 5818, we'll take 5818 divided by $1 million. We need to be buying in an area where the cap rate is about 5.88% as a minimum. And if we do, we'll then have endless maximized financing. So here it is. You need 5.88 cap rate properties to maximize financing at 25% down at 25 years at 4.3% at a 1.2 debt coverage ratio. There is some other limitations to this, but I'm not going to get into that right now. But that's generally what the baseline is going to be. So there is an exception to this. CMHC insured lending for multi-unit residential buildings. What that means is this: the Canadian government will guarantee these loans, which makes everything cheaper and better. So see properties like this? The Canadian government will guarantee this stuff and give those guarantees to finance it. We'll take $1 million property. Instead of 25% down, you can buy it at 15% down. Instead of a 25-year amortization, it's possible to get a 40-year amortization. instead of paying 4.3%, in today's market, at the time of me recording this, it's possible to get a 3.1% on a 10-year term. And the debt coverage ratio is around 1.2. So let's do the math on this. Mortgage amount, $850,000. Mortgage payment, $850 times 40 years at 3.1%. The mortgage payment is $37,000 a year. Debt coverage ratio of 1.2 means $44,000 a year. Net operating income minimum is now 44 grand. So cap rate equals net operating income divided by purchase price. $44,000 divided by $1 million means that a 4.45% cap rate would actually allow you to buy a lot of property, and that's a lot of areas in Canada that actually has that. So multi-unit financing is very appealing. Now, so here it is. You need 4.45% cap rate properties to maximize financing at 15% down to 40 years at a 3.1% and a 1.2 debt coverage ratio. So anyone that actually is out there doing that, well, here's a company that's been doing it for 20 years, Main Street Equity Corp. They own 300 plus apartment buildings, 11,000 plus apartments in total. Pretty much all of it, I'm going to assume it's all of it or most of it is going to be done government-backed financing. And the owner recently just joined the board of CMHC, and he's a world-class business owner. So there is a dead-on example of understanding where the financing is and then position everything around that versus trying to buy stuff that banks don't want to finance. So it's funny, and a 40-unit apartment building is actually sort of easy to get approvals for versus you buying 3 one-bedroom 700K condos in Vancouver. That's scalable commercial financing. Now, here's some warnings on CMHC Warning. So I get a lot of people calling me and saying, "Wow, I can buy a multi-unit building of 15% down." Yes, but it has to be in the right areas. So here's the issue with CMHC. They evaluate properties on their own internal models. What that means is they don't look at appraisals for value. So you may have an appraisal saying that these properties trade at certain cap rates with certain everything. They won't look at it. And the cap rates in certain areas can be higher than expected. And vacancy rates can be higher than expected. And this sort of happens, I would say, as the town size becomes smaller and smaller, they start to use 10-year averages on things for their calculations, which totally messes up the valuations. So another thing that's an issue is it takes 1 to 2 months to get an approval, and they may require specific repairs to be done to the building where a normal conventional lender wouldn't care for it. And as I just mentioned, they're not fans of locations with small populations. Basically, they'll give you bad cap rates for user valuations. So, and also CMHC fees will also come into play. But over the long run, if you know you're going to hold a building for the long run, paying CMHC fees, going through all of that it's the best way to acquire these properties. But if you're only going to hold it for a year or two, you're better off getting conventional direct to the lender financing. So those are my CMHC warnings. But here's the thing. Who provides the best rates for CMHC loans? Well, that's an interesting question. Well, here's the answer. The banks, big banks, do not. Credit unions do not. Monoline lenders do not. Pension funds do. More specifically, directed pension funds. So here's the question. How do you get direct access to pension funds and bypass the banks, credit unions, monoline lenders and get the best absolute rates? Well, you talk to me because I pretty much know how to go do that. So who provides the best rates for CMHC loans? It's direct pension funds. Mortgage planning. Now we're sort of the end of this presentation, but let's go. Level 3 financing, find out what the banks will lend on in general, which we've discussed quite heavily already. And then position your financials around what the banks will easily lend on. So step 2 is something that we do very well on. So let's go into that. So employed, the main issue with being employed is that you cannot increase or decrease your income. Like you're sort of fixed to where you're at, which basically means that whatever you do, you're very property dependent. And if you buy the wrong property, it can mess you up for all your future numbers for other properties you want to buy. So what it means is you have to buy the right type of property versus buying the wrong type of property. Now let's go to self-employed and you're incorporated. And this is sort of where everything becomes, this is where the amazing things of what incorporated financing can do. So here are some questions. Every year you should be answering these questions, or more like I should be answering these questions for you. How much do you pay yourself as dividends or salary? How much do you pay your spouse as dividends or salary? How much do you pay your adult children as dividends or salary? How much should be kept inside your operating company? How much should be kept inside your holding companies? How much should be transferred or not transferred between companies? What type of property should be purchased in your personal name? What type of property should be purchased in holding companies? What type of property should be purchased with your operating company? Which properties should be refinanced in your personal name? Which properties should be refinanced in holding companies? Which properties should be refinanced with your operating company? Which properties are renewing in your personal name? Which properties are renewing in your holding companies? Which properties are renewing that are guaranteed by your operating company? All of those, or every single year, these numbers have to be planned out relative to what you're going to do. And if it's managed correctly, access to financing is very scalable. And if it's not, then the exact opposite is true. And guess who does it all? And guess who does it quite easily? Me. So there's mortgage planning. I'm going back to this. Find, level 3 financing. This is the core. Find out what the bank will lend on in general. Position your financials around what the banks will easily lend on, and then you will maximize your financing. So what's the next step? The next step is really just to get a hold of me, have a 20-30-minute conversation with me. Robert at robertkleinmortgagegroup.com. Phone number 778-896-6732. I should have a link on my webpage that you can set up an appointment, or just feel free to give a call and we can set up a time. And then once I talk to you, I'll actually invite you to join our Facebook private group where we'll go into more details on these types of things. Any questions, feel free to get in contact with me. And thank you for listening.